From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Ferro. Countdown to the Open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up in the show, stocks rebound following 4 days of declines. Futures lose momentum as the markets digest the latest data and traders prepare for another busy day of Fed speak. Quick snapshot of high-risk looks at this stage. We're grappling for a base level in these equity markets. The chips went into correction yesterday. The bond market, have they already priced virtually no change from the Fed? Here you go. S&P futures up an eighth of 1%. 10-year yields tick up 1 basis point. Crude up a half of 1%. Again, you are looking at inventories building in Cushing, and you're looking at demand for gasoline on the low. So we are just looking at a less fraught geopolitical situation right now. And the Philadelphia chip gauge, NVIDIA, is down more than 10% from its peak. You're going to get a whole rolling set of narratives about buying the dip in some of these tech stocks. Let's get to Washington. Jonathan Ferro is standing by with the IMF Director. Jonathan, good morning.
Hey, Manus, thank you, buddy. Good morning to you. Standing by alongside me, I'm very pleased to say, the IMF Managing Director, Kristalina Georgieva. Kristalina, thank you so much for hosting us here in Washington, D.C.
My great pleasure.
You and I have got a lot to talk about, and hopefully we've got enough time to talk about it all. So let's start here. The biggest risk to global stability right now, is it right here in the United States? Is it U.S. policy?
Well, U.S. policy has helped the world. Let's start from there. During the pandemic, the fact that U.S. stepped up meant a lot in terms of stabilizing the world economy. And today, when we are upgrading our growth projections from 3.1 to 3.2%, to a great degree, thanks to the United States. This being said, all eyes are on the United States. One, what is going to happen with inflation and interest rates? Two, how is the U.S. going to navigate this world of more intrusive government policies?
Let's talk about the FX market to begin with. I wonder how happy the Japanese are. I wonder how happy the South Koreans are, the Malaysians, the Indians. I go through it one by one. In the FX market, as you know, Kristalina, we've got a record low for the rupee. The Malaysians have had to intervene in the FX market. The Japanese, the South Koreans are threatening to. Can you give me just a decent impression of what that's been like at the forum so far, the spring meetings? What have they said to you about that? How loud are the complaints?
Of course it is concerning because, as you said, when the dollar is up, many other currencies are down. Not all, but many other currencies are down. And what that leads to is concern about how long that may last. So that's what I hear from countries. How long would the Fed be stuck with higher interest rates? And when they start easing, can we expect that this would take the interest rates in the United States down a little faster? And the answer to these two questions is not an easy one. On the interest rates, the Fed is doing the right thing. They're watchful. Keep your eye on the ball. And at this point, the ball is bouncing up and down, and the Fed is not yet prepared, and rightly so, to cut. We still remain optimistic that within this year, conditions in the United States would allow the Fed to start cutting. For how fast, I don't think that we should gear up for rapid decline in interest rates.
Can I jump in and ask you what you think the source of that optimism is? What's behind that? What leads you to believe that those interest rate cuts are coming?
Well, what we're seeing is the economy is indeed slightly overheated, but part of it comes from the fiscal stance of the United States. So there is room to cool a bit the economy just by being more watchful, and it would help the United States overall because as we know, deficit has gone up to 7%. The second reason is that so far the business environment in the United States has not reacted very firmly to the interest rates being high, but we see a little bit of softening underneath, especially in SMEs, and that tells us that high interest rates ultimately bite.
Can I tease that out just a little bit more? Are you effectively saying to us that the US exceptionalism that so many people are talking about is ultimately unsustainable?
I didn't say that.
I'm asking.
I would tell you, what are the sources of this exceptionalism? And I think they're with us to stay. One is very deep capital markets. People are coming here not only because they can generate more income with high interest rates, they're coming here because the economy is very vibrant and capital markets are deep. Second, innovation in the United States moved very quickly from idea to a venture and then to scaling up. And three, the US is tapping into a very vibrant labor force right next door. What in the eyes of many people is a problem, and I admit there are elements of this flow of people that is concerning, is actually feeding into the labor market of the United States in a way that keeps wages lower than in some other countries and keeps the ability of businesses to grow basically unlimited.
You understand why that's a difficult political message, don't you?
Of course, and I would translate it in the following way, something that I think everybody in the United States is looking for.
Yeah.
Good, sound, transparent immigration policy. The US, if you look at the sources of growth on the labor side front, it is more people coming from outside that fed this exceptionalism of the labor market. But it has to be regulated. It has to protect the American people from those who may be coming here with bad intentions.
I can tell you something that's politically popular in America and elsewhere too. It's going after China. Excess capacity and potentially dumping goods on the international market. We're not just hearing that complaint from the United States, we're hearing that complaint from others as well. What's your message for the Chinese government at these meetings with those concerns in mind?
I was in China recently, and my message there is the same I would convey today. China is on fork on the road. They can continue with their traditional policy, and that includes industrial policy on scale towards export, or they can shift gear and concentrate on domestic consumption, on beefing up demand, and on continuing with market reforms that served them well in the past. We know from experience that industrial policy often produces misallocation of capital and labor. We are today in a world of weak growth prospects. The last thing we need is more misallocation of capital and labor.
The last thing we need is exactly what we've got, I'm afraid, Kristalina, because we're seeing industrial policy take off in America.
True.
We're seeing the Europeans trying to come up with their own form of it. It might take them a while. We know how Europe works. China's been doing this for a while. What you just said about China, I heard a decade ago, you've heard for the last 2 decades that they're going to shift this economic model. It doesn't appear that they are. I think a big question for us at these meetings, and I'd love for your input on this, I caught up with John Lipsky this morning, and I said, how does the IMF retain and regain some relevance in this conversation to help reshape these outcomes? Because we're drifting away from free trade. We're breaking away from cooperation. We're going somewhere else.
Well, 2 responses. One, how do we, I wouldn't say regain, because I think we have quite a lot of relevance on that conversation on fragmentation and the benefits of an integrated global economy. We just have to continue to bring the facts in an objective manner. And the facts are that when we go excessively in protectionism, in industrial policy measures, we risk to actually affect negatively prospects for growth, and we certainly create a wave, a down spiral, because experience tells us every measure of protectionist nature has 75% probability of reciprocity. And then where do we end? But the second point I want to make, and I'm making it most sincerely, we are in a world that is faced with massive transformation, the digital transformation, the clean economy that we aspire for. There is some value in using industrial policy to accelerate decarbonization, to make it so that the benefits of the digital economy are more fairly shared across society. In other words, when there is a market failure, yes, it is justified. You take a measure to correct it. Our worry is that when we looked at the massive increase of industrial policy measures, a good chunk of them do not reflect the market failure. So we will continue to speak truth to power.
Let's talk truth to power right now. We've got some spies around here. They know they saw you with the central bank governor of China yesterday evening. Can you tell me what you said to him?
What I told him is twofold. One is that China needs to continue to seriously address the problems of the property sector that have been handled somewhat, but not resolved. They need it for domestic consumer confidence, because many Chinese people think of their apartment as their saving for old age. They also need it because a sector of that significance cannot be put on hold. The second thing I told him is that we are now starting our Article 4 consultation. This is our annual taking the pulse of each economy with China, and that it may be very useful for China if we do more analysis on how they can boost domestic demand, how they can exercise their own decision for a dual circulation economy. Yep. And I was delighted that he sees value from the fund to get deeper in these issues and provide China with appropriate advice.
They're coming under pressure, you know, they are politically, not just from this administration, Secretary Ailman, but potentially another Trump administration as well. Mm-hmm. Do you have any concerns that they'll lean towards the FX market and just seek out a weaker currency?
Well, we haven't seen signs of that. But what I do believe is that yes, if China builds overcapacity and pushes export that create reciprocity of action, and then we are in a world of more fragmentation, not less, that ultimately is not good for China. China wants an integrated global economy. Therefore, what I want to see China doing is to get serious about reforms, get serious about demand and domestic consumption.
We've got so much to talk about, but unfortunately, I know you've got other things to do. Let's continue this conversation through the year. Kristalina, thank you so much, and congratulations on a new term.
Thank you. Look forward to continuing.
Thank you so much. The IMF Managing Director, Kristalina Georgieva. I'll throw it back to you guys.
Jonathan, thank you very much. Great conversation there. A lot to chew on, from currency risk to reform within China. The whole team are in Washington over the next couple of days. We're going to catch up with Chris Ailman. He's been listening into that conversation from CalSTRS. That's next on Bloomberg. Listening into that conversation at the IMF meetings to the head of the IMF is Chris Ailman of CalSTRS, joining me now on set. Good to have you with us. We both sat listening to that. Some very clear messages from the IMF to China, which is about rebalance, stimulate internal demand, and don't bank on any fast and furious rate cuts from the Fed. I think three very important messages. What matters the most to your world?
China matters because it's the second largest economy. It's not a huge holding in our portfolio, but we've got to recognize its place in the world is so critical now. And I thought the comment about the housing market was very interesting because it's been a problem for a long time. They really need to manage that properly. And the focus internally into China's domestic economy we know from just what our general partners and our asset managers have said is dominant in the Chinese government and their focus of the party is their own economy. And it needs to be strong. It's a big chunk of the world.
Because that permeates not just to perhaps your overseas allocation, but also here to the US as well.
Well, exactly.
They've got to get it right. Big macro policy response from China seems to be something of you know, the early 2010s, 2011s, and that's not the policy road it looks as if we're traveling.
Well, and you look at, it's amazing how many people they've taken from poverty to middle class, but now they have this gigantic middle class that wants employment, wants stability in their housing prices, and that's taxing all their efforts.
Now, when it comes to managing massive amounts of money, there's you, and then there's the Norwegian Sovereign Wealth Fund as well. And earlier today, I caught up with Trond Grande, Deputy CEO of the Norwegian Sovereign Wealth Fund, and this is what he had to say about tech.
Okay.
It has become the biggest sector of our investment portfolio, but it's also a very expensive market, or if not very expensive, it's pretty highly priced. So that's why we're being a little bit careful.
Well, from macro policy to equity allocation, it's a swift pivot. But I thought it was an interesting salutary warning about how expensive tech has become. You have your allocation to tech. How much more cautious are you becoming on that allocation? How much caution do you have around technology? All hail NVIDIA.
I'm cautious all the time. Well, and, you know, let's recognize he's, what, 5-6 times my size. So, and they own the equity market. So technology is not just in U.S. equities and just in equity. It's in our private equity portfolio. It's in our real estate portfolio. It's in our infrastructure portfolio because of the energy demand on technology. And I agree with his concern about valuations. It is priced to perfection. But we are literally, I mean, Jamie Dimon said it's equivalent to the steam engine. I'm not that old, so I don't know. But maybe the invention of the light bulb? I mean, that dramatic. The hope for AI is probably overpriced and overshooting. But it really is a dramatic change in technology that will affect all of our lives. I have no question that a year from now we'll be shocked at how many types of AI products we are using and maybe not even realize it. So I think that they're overly optimistic, but they have a reason to be optimistic.
But you would say from the macro policy point of view, perhaps we're over hoping for the productivity gains that come from AI. That is your cautionary point, isn't it?
Well, always. The markets overshoot. They're over optimistic about especially new technology. And I worry, you know, the difference this time is companies are making real money on these things. And giant companies are leading this effort. This is not like a .com era where we have, you know, flyinyoursuit.com and every crazy idea. This is Amazon and Google and Microsoft and Apple leading the charge.
I would just say that Dan Ives was with me. He said it's a get out the popcorn moment for tech. It's going to flex their muscles, and we're going to look back at this mini dislocation as perhaps being one of the greatest buying opportunities. Is that a stretch too far?
Yeah, well, I would say so, but you need a market. You need somebody who's going to say that, because there's also somebody like this week who's selling it. So you need both sides. Look at how far the market has come this year alone, and mostly based on that Magnificent Seven. It's overly optimistic, but that doesn't mean that it shouldn't be optimistic.
The same question for you as we had for Norges Bank, which is 70 basis points hike in rates in the 10-year bond yield. A lot of that is over the past month.
Yeah.
Is the worst of that bond ride over? Is that a moment, a Damascene moment for the bond market, that it recognizes that you're not going to get fast and furious rate cuts from the Fed? Are we done on the worst right in the bond market?
Tough to always call a top in the market. I thought Vanguard's point today that it could actually, the 10-year could back up to 5%. I was really shocked to see that line, only because the market was so optimistic at the beginning of the year with 6 rate cuts. Now we're down to 1, and the equity market has taken it in stride. So I haven't been popular, but I've been saying for over a year, you've got to take your cues from the bond market, not the stock market. And the bond market is telling you that rates are going to stay higher for longer. And, you know, with the IMF, the interesting question, a rate cut, back to where? What is the base rate? It's not 0. I think the base rate is probably higher than 3, probably 4. So, and right now the economy is doing great with rates at 5. I don't know if we need to cut.
With that in mind, again, we've seen the repercussions of higher for longer. I would say the beginning of the repercussions of higher for longer. One of those is the commodity trade. One of those is the inflation trade. How are you and the board and the investment committee looking at inflation protection moves, additional inflation protection moves within the fund?
We actually have that as an asset class because we recognize that inflation is going to be sporadic, but it is higher for the next 2 decades than it was in the prior 2 decades.
Right.
And for traders, generally in this work environment, that's a surprise to them. I've been around long enough that I know inflation can be persistent and higher. So I think investors, particularly retail investors, are going to have a hard time finding inflation-protected securities in their IRA, in their portfolio. Physical assets like real estate do okay, but we're seeing inflation jump up in different ways. And I think people need to look back at fixed income. It's an investment opportunity and it belongs in your portfolio. That nice steady income is nice to have as the markets ebb and flow. We haven't had a recession in a long time, so I think people really need to be more balanced in their portfolio, and that's what we're trying to do. Physical assets like infrastructure, as well as real estate and other opportunities. It's got to be a blend.
Again, the narrative around commercial real estate is that it's been a tough time. It's been turbulent. There's been moments of existential angst, to say the least. Would you be inclined to take opportunity if there are major drawdowns again in commercial real estate? To take opportunity. Norges Bank are prepared to. So what's your view on real estate?
Well, in Norges Bank, I mean, when you look at their portfolio, they're primarily 7%. In public markets securities, just starting to go into what I would call private market securities, real estate private equity. At their size, that's enormous. And within real estate, you've really got to bifurcate that market. The office market, no question. That was changed because of the pandemic. That is a new existential change on what does office mean. Manhattan's packed. I get it, so office is fine here. But in the middle of the country, office is vacant oftentimes for huge parts of it. But other parts of real estate are very attractive. Warehouses, apartments are still in high demand. And now you're looking at subsegments of student housing, senior housing. For us, we're big in the biology and life sciences buildings, very specific type structures. So real estate has still a huge value. And I think U.S. investors are looking at non-U.S. and non-U.S. are looking at real estate. So some segments, office needs to come down even further. It needs to readjust to that 5% rate.
Just to square it away very quickly, with bond yields at this level, maybe even touching 5%, are you duty-bound to step in and pick up duration? Are you tempted at these levels?
Well, not just tempted, we are. We have been feathering into fixed income throughout this year. We're going to continue to. And for us, fixed income, as rates went to zero, we lowered our allocation all the way down to 11%. Now we're in the process of rebounding that back up because we found it attractive.
And do you blend that up with IG? If you're feathering the nest, as you say, then what's your proclivity to investment grade and to high yield?
Well, when you buy the Bloomberg Ag, you buy the entire part of the curve. We like sovereign debt in terms of taking the rate bets and duration bets. And what I'm seeing with ourselves and our peers is investment grade credit is attractive, but you can get a better return and some flexibility out of private credit. And since that's oftentimes variable rate, it improves your convexity and the ability to manage the curve.
Look, bonds to a certain extent over the past 48, 72 hours, at certain moments, behaved in a way which one could say was a hedge, which it was what they traditionally did in moments of real angst on Friday in regards to Iran, Israel. Do we see those hallmarks remain and indeed reassert themselves as a source of a hedge and a haven?
I think we do. As we back away and look at the whole world for opportunities, particularly in those kinds of crisis spikes. And it was interesting. I turned on Bloomberg Radio on Saturday morning, and the only thing that was quoted was gold and Bitcoin, because it's the only thing that trades on the weekend. But what really mattered, those trades were minor. What really mattered was people running into 30-year U.S. bonds. That is still a safe haven. And thank goodness, because we're a debtor nation. We need to borrow a lot of money. So I think that the bond market and the U.S. bond market is still an anchor to safer for global investors. It will continue to be. And I think it needs to be part of everybody's portfolio. So many investors are just focused on tech and on public equity. They really need to balance it out with fixed income in their portfolio. And it's got a return, a positive return with a nice steady yield. That's worthwhile grabbing.
We'll take a bit of that and put it in the back pocket. Chris, thank you so much for joining me. That is Chris Ailman, my guest this morning on all things in the markets. So as we look across the IMF conversation that Jonathan just had with the managing director there, which is about the question of the strong dollar. That is the conversation that is happening in Washington. Her call about immigration, it's an unpopular call, but in terms of the benefits from immigration in regards to capping out those wage rises that we are seeing. And if you think that you're going to get a fast and furious cutting narrative from the Federal Reserve, she is very, very doubtful. The Fed may well be stuck in this higher for longer narrative than many had anticipated. In terms of the message that she gave to the PBOC when she caught up with the head of the PBOC last night, it was about stimulate internally, stimulate domestically, and indeed make sure that you right the housing market to a level that gives the middle class confidence to spend within China. Let me get you up to speed with your morning calls in terms of what the analysts are talking about on Wall Street this morning. First up, Deutsche Bank downgrades Tesla to a hold, expecting recent production delays to weigh on quarterly results. Next up, Morgan Stanley. Now, they're double upgrading eBay. They're going to go to overweight on that, citing a boost from artificial intelligence. And finally, JPMorgan upgrades JetBlue to neutral. They say that the company is well positioned to take advantage of improving sentiment. There's one thing that you really got to keep an eye on. These are the equity markets. We're up 0.25%, but it is the call from Vanguard that 10-year government bond yields risks rising to 5%. We've just had a conversation with CalSTRS there saying at these levels in yield, you do want to be picking up some yield. 10-year government bond yield at the bottom of your screen, 4.59. Vanguard's narrative this morning is that on the 10s, a move past 4.75 could lead to a disorderly sell-off. And if that happens, that's what can take you back to the danger zone. That danger zone is a break of 4.75. Breaking that danger zone can take you to 5%. We're taking up barely one tick at the moment. But in terms of the narrative for the bond market, we think there's a residual long position left out there. So keep an eye on that. And rolling it across assets, we're counting down to the opening bell right here on Bloomberg. Let's just listen in to Kristalina Georgieva and what she had to say just a few moments ago.
We still remain optimistic that within this year, conditions in the United States would allow the Fed to start cutting. For how fast, I don't think that we should gear up for rapid decline in interest rates.
Can I jump in and ask?
Okay, let's talk about a couple of the stocks that we're watching here today at the Open. First up is Micron. The chip maker is set to get $6.1 billion in grants from the Commerce Department next week. That's according to our Bloomberg reporting. Ed Ludlow has the detail. Ed.
Yeah, let's see how Micron opens, but it's a big number. You're right that $6.1 billion is in grants, and that's important. According to our sources, that figure could be announced as soon as next week. There is a loan component to this as well, where sources say that Micron will accept loans on favorable terms as part of the funds made available by the CHIPS Act, just as Intel and TSMC did. But we don't know what the dollar value of those is. So the total package could be much larger than the $6.1 billion. Micron's got plans, both in Boise, Idaho, its kind of home state and city, and New York State. And what's interesting is that it has 4 locations and projects planned in New York. But regulatory filings recently told us that 2 of them will not be operational until 2041. That's important because Gina Raimondo and the Commerce Department have said that the allocation of funds will be prioritized relative to those projects that can be finished sooner, basically, by the end of this decade. And that would indicate that at least 2 of those New York projects will be on that timeline. And so the entirety of the funds awarded in this tranche will be related to that project. Stock, I've lost track of time, Manus. As you know, I'm a bit of a night owl anyway. We're down 0.9%. Whether the market's open or not, I believe it has now. Thank you. It's an important one. Micron, a big maker of memory chips, a market that is dominated by first Samsung and then SK Hynix, the Korean names. But as you know, if you look at the table in the Bloomberg News story of where funds have already been allocated, those same Asian chip makers are also coming for the US manufacturing footprint. that the domestic players won as well. So it's interesting. The stock had been significantly higher in pre-market when we broke this news. We're now down almost a percentage point this Thursday at the market open.
OK, thank you very much. The latest update there on Micron. Let's turn to casinos now. Las Vegas Sands reporting results. It's Macau locations that missed on the estimates. Abby has the detail. Abby.
Well, investors really not liking this, Manus. We have the stock down more than 6%, heading to its worst day in about a year. And you're exactly right. It's not the overall operations, because on the surface level, they really put up a nice beat. They put up 75 cents in adjusted profits. That's 25% better than what the street had been expecting relative to revenues, $2.96 billion, essentially. That is a small beat. But when it comes to Macau, and that is more than 60% of their operations, they really missed the estimates. But it's not just the quarter that was. Looking ahead, some analysts are saying that they have to invest for renovations, so that could weigh on profit. And then just uncertainty in China. What also makes all of this worth noting, Manus, is so many stocks and the stock market itself up over the last year. That is not the case for Las Vegas Sands. So the uncertainty around China has been weighing for a while. Coming into today, down more than 15%. So with this stock down 7%, again, the worst day since May of last year, we now have the shares of Las Vegas over the last year in a bear market.
Abby, thank you very much. Let's turn our attention to airlines. Alaska Air expects second quarter profits to top analyst estimates, signaling that the carrier is recovering from its Boeing crisis. Katie Greifeld has the detail. Katie.
Yeah, we know that the first quarter was a little bit rough for Alaska Air. Of course, we remember that January incident, and then you had federal aviation regulators grounding all 737 MAX 9 aircraft after that incident until the inspections could be completed. Alaska Air did earlier confirm that some travelers had opted to fly on other airlines for a period after that incident. But looking ahead for the current period, they actually raised their forecast for adjusted earnings, saying they will be between $2.20 to $2.40 a share for this quarter, really backed by that surge in travel by tech companies in particular. Analysts had been looking for $2.12, so a big beat there. And then you take a look at their forecast for the full year ahead, and that actually beat expectations as well, or rather they raised it. So EPS for 2024 expected to be between $3.25 to $5.25. The previous range had been $3 and $5. So a raise there. Definitely what shareholders wanted to see. You see shares currently up higher by about 1%, had been as high as 4% higher a little bit earlier, but definitely an up day so far for Alaska Air.
Katie, thank you very much. Stock reacting nicely there. Turn our attention to the home builders. D.R. Horton increased sales expectations for its full fiscal year. This is the housing market heads into its key spring selling season. Simone, how does the season look?
Well, on the earnings call just now, executives have been talking about this, and they said they've actually seen the market stabilize and seeing, quote, a very good sales pace in line with our overall plans, even despite the higher rates that we have seen into April. But as you mentioned, Manus, the company able to raise its sales projections for the full year, which ends at September 30th, now seeing building 89 to 91,000 homes and selling them. That was 87 to 90,000 homes. Second quarter results pretty positive here, coming in ahead of analyst expectations with home orders up 14% year on year. Pre-tax margin also higher than expected, and that allowing the company to deliver a beat on its earnings at $3.52. The expectation had been $3.07. Now, again, we're paying attention to the call here. Citi said cancellations were well below expectations, but it wants to know how that plays forward, wants to know more about buyer demand and traffic in April. Jefferies calling this a robust beat, but on the call, it's really going to be focusing on those margins, given the incentives, the buy downs that D.R. Horton has been offering. Shares, though, were higher now, but now up about 2.5%. They had been up their most since December. We'll see where the day closes, Manus.
OK, Simone, thank you very much. Let's continue the conversation about risk this morning. JPMorgan's Kelsey Berro and Moneta's Aoifinn Devitt join me. In terms of the narrative that we're just hearing from the IMF, in terms of the message from the bond market, which my last guest said of CalSTRS is perhaps the most important bell ringing in our ears. We're in a higher for longer narrative. With that in mind, Aoifinn, let's start with you. This higher for longer stockflation narrative, how do you interpret that?
Well, first, it's a new narrative. We were speaking about Table Mountain and how long it was going to last, but we certainly thought that that table was coming to an end soon, and we were looking at those cuts. So now it seems somewhat exhausting that we've done this round trip in terms of Treasury yields, and we're right back to where we started a few months ago. That, of course, does have implications for stocks. It has implications for the bond market. The 60-40 portfolio won't look too good if the total return of bonds are falling. And it just puts everything in question again. It's like, are we right back to where we are before? What does this mean? How long can these higher rates be supported, be sustained by consumers and corporates? So it does, unfortunately, add to that wall of worry.
Kelsey, how are you feeling about it? Are you exhausted? Are you exhausted? We're sort of back to where we started, as Aoifinn just said. Do you sense a level of exhaustion here? We haven't quite broken the 475 yet in bonds. Take me through your view on stockflation.
So in terms of exhaustion, we have seen a significant repricing in yields. I look at the one-year rate, and it's over 100 basis points higher. So the market has already efficiently responded to the stronger growth and stronger inflation data. But I think the differentiation between now and, let's just say, October of 2023, where a lot of people are drawing those parallels, is back then, the Fed wasn't done hiking yet. It was still not clear if they would need to go further, and the market was pricing in additional hikes for 2024. Today, we're in a different environment, an environment where there are limits to how far yields can sell off, because ultimately the Fed is deciding between two outcomes, not three. There used to be three choices: hike, stay on hold, or cut. Now there's two choices, which is stay on hold or cut. So these higher yields, what we're hearing from our clients is actually are a great opportunity to get invested at these higher yields and start building a portfolio that has diversification and has income again.
Well, tell me, Aoifinn, then, I mean, you said the 60-40 portfolio, of course, will have taken a hit just by the virtue of the fact that bonds have underperformed so much. But what is it that would make you take investment grade or sovereign yield? Do you think there is one more leg higher in yield to come in these bond markets? Or do you incrementally add and say, OK, 60-40 will begin to return to normal performance in the back end of the year? You've got geopolitics at play, and you have some people saying you will still get 2 insurance cuts. Some people are saying 6.5% rates. But the thesis, the consensus of the market is at least 2 insurance cuts.
Exactly.
Well,
right now, because we... Oh, sorry. because we know that inflation is coming down. We know that that makes that real rate of return all that more meaningful. We know how much investors rely on income. They haven't been getting income from the equity market. The concentration in the equity market has made it look a little unsettled. And there is quite a bit of, I think, fear around there. We're seeing volatility pick up and a lot of noise circulate. So I do think fixed income makes sense today. Just like your previous guest, Christopher Ailman, mentioned, it's not just public fixed income. It's private fixed income. It's right along the spectrum. It's playing that exit of banks from the lending segment. Banks are actually doing quite well. We've seen that in the equity side. It's good that finally another segment is starting to come to the fore. So I do think the case for fixed income is there. Technically, because spreads are so tight, I'm not seeing a ton of enthusiasm around pricing where they are today, especially in high yield or investment grade. But I do think that as having a role in the portfolio with these levels of yields and inflation coming down, it does make sense.
Kelsey, I'm heartened by the fact that you say there are limits to how much further this sell-off can run.
So we think there are limits to how much further yields can rise because the Fed is still in a mode where they think they've done enough. And the next move is either to stay at these levels or to move lower. So what is causing that conviction for us is ultimately we do think that inflation should be moderating. We need to see it in the data. The Q1 data was a little bit of what we hope to expect to be an outlier, but we do expect inflation to be moderating and growth to be moderating. When you look at Q3, we were running at 5%, and then Q4, we were running at 4%. Now Q1, we're running at 3%. These are great growth numbers. They're a great backdrop for corporate fundamentals, but it is still an environment that's moderating. Ultimately, the Fed is in a good place here.
Do you think, Kelsey, it's wages that moderate more quickly than we presume, or is it that growth slows down more materially? I was listening to the global head of economics for UBS on surveillance just at the end of the show. He said the sources of growth in the United States of America are narrow. They were fiscally driven in 2023 through the IRA and through the CHIPS Act, and that those fiscal boosters will dissipate. So this slowdown, the confidence that you have, what is that most predicated on?
Yeah, so our confidence is not about growth rolling over or being very negative. It's really just the fact that it's healthy, but it's not necessarily reaccelerating to the point where the Fed needs to re-engage the hiking cycle. So that's really the differentiation. But I will say on the wage front, that's probably the area where we've had the most consistent amount of information that is pointing in the right direction. I turn even to the Beige Book released yesterday. There was a comment in there about, in general, wage gains have basically returned to their historical averages. So we had a period where there was a very intense labor shortage and the employee had the upper hand. That's really just returning to normal. It's not indicating that the labor market is weak, but it's indicating that the labor market is more balanced.
Even if we can close off with a comment from you. I know that you've been looking at the dollar. It's the only thing that anybody's talking about in Washington. It's amazing how the conversation shifts from our markets here in New York to the IMF meetings in Washington, and it is about the dollar strength. And you now have a trifecta of admission that that strength in the dollar is something the US is prepared to allow the Japanese and the South Koreans perhaps to reduce. Your interpretation of the strength in the dollar and Yellen signing on to this press release, which we would say tacitly allows the others to intervene.
It's very interesting right now. We have on the one hand, and again mentioned earlier, the rise of gold and Bitcoin, suggesting a concern around currency debasement and some concern around those rising levels of debt at a country level. And then we also have the US dollar being so strong, the juggernaut of global growth and the penalty that that represents for other countries, essentially, and how we now end up with the US continuing to be in the lead. So it is a problem, this strong dollar. We have to remember we're dependent on a global economy. It cannot be sustained forever. And we think that is going to ultimately show the ongoing weakness of our trade partners. So it is interesting. And it probably should not be sustained. But then again, that's the anomaly that we see this concentration in markets continuing to exist and really distort the picture.
Well, I'll leave you with this thought. It was 2019, and that's when the US accused China of being a currency manipulator. Japan and South Korea were on the same list as well. How things have changed. Aoifinn, thank you very much. Aoifinn Devitt, Kelsey Berro on markets this morning. It's all eyes down for Netflix. They're going to kick off another round of big tech earnings.
I think there's certainly room for upside. Netflix has positioned themselves to get a little bit more focus, shifting from the subscriber growth to revenue overall, given their ad-supported tier strategy.
Let's hope you're not sharing your password. Netflix down just over 1%. We'll dig into what the reports are expected to give us on Bloomberg.
I think there's certainly room for upside. Netflix has positioned themselves to get a little bit more focus, shifting from the subscriber growth to revenue overall, given their ad-supported tier strategy. Our survey work during the quarter continues to show the absolute stickiness of that premium tier.
Netflix will kick off the big tech earnings after the closing bell today. Analysts are expecting streaming leader to register another strong quarter of growth in subscribers following a crackdown on account sharing. Geeta Raghunathan is from Bloomberg Intelligence. So all eyes down on the subscriber growth. Where will the alpha of growth come from geographically, Geeta?
Yeah, Manus, it's always kind of been more on the international side. So the US is a pretty mature market right now. That said, their new initiatives, both with the ad tier as well as the paid sharing, where they're cracking down on password sharing, has definitely helped kind of reinvigorate US growth. But majority of the growth there going to come from the international markets. Asia Pac and Europe are the big ones there.
And to sustain that, I mean, they've got multiple growth drivers. I'm just curious How does pricing going to play into this? I mean, I look at my own TV. I think I've got Amazon Prime, I've got Apple TV, I've got my Netflix. I'm a multi-channel. But even I'm nearing the limit of what I want on the television in front of me. I'm not that price sensitive, but tell me about the rest of the market.
Yes, I think what Netflix has managed to do is in many ways, Manus, they have really won the streaming wars, and they have kind of become this de facto option right now for most households across the world. I mean, if you're thinking of entertainment or what do I watch today, I mean, you kind of tend to gravitate towards Netflix, and that's what they can really bank on when it comes to pricing power. So they definitely have the edge relative to their rivals. And if you just kind of think about, you know, the US itself, their standard plan, which costs about $15.50 a month, the last time they raised prices on that was back more than 2 years ago, January of 2022. So obviously we're due for a raise there. And I think what really kind of gives investor comfort in terms of are they able to raise prices? I think yes, it's a resounding yes, because now they have this lower priced advertising option. So anybody who's very price sensitive, obviously they can control churn because you do have that lower priced option now for, you know, $7 a month in the US.
Okay, Geeta, thank you very much. Let's see what the numbers say tonight. And who out there doesn't press yes when it just comes up, the price has risen, do you want to continue with your subscription? The bond market matters. Listen to it more. That was the message from CalSTRS, who were with me just a little bit earlier. Now, yields are popping ever so slightly higher. The US jobless claims come in at 212,000. The estimate was for 215. So a solid jobs market. Another reason for the Fed to obfuscate, to extend and pretend. But I'm drawn to Williams' comments from the Federal Reserve, where he says rate hike is not the baseline, but possible if the data warrants it. So again, they're trying to reaffirm that rate hikes are not our baseline. But he does go on to give you the counterbalance. So the bid and the offer, which is they will cut rates at some point. The economy will drive the timing. So there's a number of facets in this bond market this morning. Monetary policy is working the way we hoped. Those are the lines coming from Williams. Let's get into the sector price action. Abigail Doolittle is with me side by side.
So it's another interesting day early on, Manus, because we have already had stocks start higher and then go lower. Right now, up ever so slightly, a pretty even split. Actually, we've had a number of sectors just over the last couple of moments go ever so slightly higher. The best sector on the day, though, communication services up about 0.6%. Financials, industrials also higher to the downside. Tech and discretionary utilities. No big moves, though, right now. Investors are trying to figure out what's what. Where we do know what are the chips. We have the stocks down 1.2% over the last 4 days or this week. I believe that's what we're going to see here, down nearly 5% on the month, heading to more than 8% decline, the worst in many, many months. And of course, there's fears for NVIDIA, too far, too fast. I'd also point out yesterday the possibility of tariffs by the U.S. Against China on aluminum and steel. Well, of course, the poster boy for tensions between the U.S. and China, that's chips. So I think that there's some tension hitting the chip sector on that possibility as well, Manus.
Yeah, well, NVIDIA down 4% on the week. It's got a small bounce in it this morning, Abigail. You're right. Those chips are a real focus for us at the moment. Coming up in the show, we'll give you the market moving events to set your clock by right here on Bloomberg. Markets are struggling for a really clear direction at the moment, as you can see. NVIDIA's up by 0.5%. S&P barely holding on to its 5,000 level. Let's see how that plays out through the rest of the day. We're going to get those Netflix numbers later in the day. That can help define perhaps where some of the big tech sentiment goes. Now, in terms of the rest of the agenda, it's a matter of moments before we get the existing home sales for the month of March. As I said, Netflix will come in after the bell. And then tomorrow, India's general elections begin. And we get the earnings from American Express. That was Countdown to the Open. We've been off to the IMF meetings in Washington. A very clear message from the Managing Director there, which is about China. Rebalance China. Boost your domestic spending. And in terms of the angst over the strong dollar, Well, let's just see what happens next. But that is as much a political statement from Janet Yellen as it is about a financial statement in terms of the strength of the dollar and what the Japanese and the South Koreans can do. We're struggling for clear direction in equities. We'll get a little bit more clarity as the day rolls on, right here on Bloomberg. Good morning.